Okay, good evening, everyone. I'd like to call this meeting to order. If we'd all stand for the Pledge of Allegiance. Pledge of Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Can we have roll call, please?
Yes, Councilmember Justin.
Yes, here.
Councilmember Larson.
Yes.
Councilmember Whitten.
I am here.
Councilmember Bozak.
Present.
Councilmember Rivas.
Here.
Councilmember Conover. Councilmember Graham.
Here.
Commissioner Good.
Present.
Commissioner Blaney.
Here.
Commissioner Biggs.
Here.
Advisory member Vesely.
Here.
Advisory member Ritchie.
Here.
And advisory member Wood.
Thank you very much. Good evening.
Mr. Chairman, I'd like to make a motion that we approve all these minutes on the agenda.
Second.
Motion on the floor that has a second right out of the gate. Pigeon and roll, baby. Got a couple of matters of business to take care of prior to the Capital Cities presentation. Any discussion on the minutes? Seeing none, all those in favor signify by saying aye.
Aye.
All those opposed? Motion carries. Next, we move on to our annual reorganization for the foundation and our annual election of officers. And first position that I'd like to offer up is for the position of foundation president.
I'll nominate Mike Jessen.
I'll second that.
There's a motion on the floor that has a second for me to remain as foundation president. Any discussion? Roll call, please.
Councilmember
I'm a vote
Larson.
no now. Yes.
Councilmember Whitten.
Yes.
Councilmember Bozak.
Yes.
Councilmember Rivas.
Yes.
Councilmember Graham.
Yes.
Councilmember Justin.
Yes.
Commissioner Good.
Yes.
Commissioner Blaney.
Yes.
And Commissioner Biggs.
Yes. Can I vote?
All right, thank you all very much. Next, we'll move on to the foundation vice president position.
Nominate Dan.
Yeah. Second.
Motion on the floor that has a second for Dan Whitten to remain as the foundation vice president. Any discussion? Seeing none, roll call, please.
Councilmember Whitten.
Yes.
Councilmember Bozak.
Yes.
Councilmember Rivas.
No, I mean, yes.
Councilmember Graham.
Yes.
Councilmember Justin.
Yes.
Councilmember Larson.
Yes.
Commissioner Good.
Yes.
Commissioner Blaney.
Yes.
And Commissioner Biggs.
Yes.
Okay, congratulations.
Painful.
Hesitation from Commissioner Biggs, duly noted. Okay, moving on to the agenda for this evening with Capital Cities presentation. We'd like to turn it over to you folks to go ahead and tell us what you know.
Great, thank you, Mike. If you could go to the considerations and observations on the PowerPoint, that's where we're going to start, which for you, with your presentations in front of you, it would be behind just the cover page of our report. So each quarter we do a project, and it's really meant to meet your fiduciary obligations. In the first quarter of each year, we do an annual review of the previous year and kind of give our perspective on some of the things we're thinking about for 2018. Peter's going to cover that in a few minutes. I'll cover the report, and then we have some operational things that are important at this stage to discuss, because some of them involve distributions from the fund, and I'll let Peter go over those.
Absolutely. Thanks a lot, Joe. Just an update on the externally held municipal bonds. We did have 2 of those mature in January. This is obviously a report for the end of the year. So in the report, it will still identify that they're outstanding, but they did mature on January 15th, and actually some of those cash flows were used as part of the 2017 distribution just because the cash was made available. Additionally, last meeting, you voted to exchange the Vanguard Institutional Index for the Charles Schwab S&P 500 Index. That was the passive fee exchange, our fund change based on fees that you approved last meeting, as well as moving into the government money market fund. for the cash position in the portfolio. Those changes took place in December. There's no further action. We just wanted to notify you that they did take place. Additionally, the share class exchange for Loomis Strategic Alpha was executed in January as well, and as you saw, that share class exchange dropped the fees on the product from 75 basis points down to 68 basis points. That's one of the things that we're doing on a continual basis, just to monitor and make sure that you're invested in the lowest possible vehicle for the investment. And then, as you can see on the distributions, took two distributions, one right at the end of December and one for 2017 went out in February for just shy of $13 million. So those took place without any hiccup. So we're happy to report that for you.
Thank you.
And then if you'll flip behind tab 2 and turn your book sideways, because it's a landscape presentation.
And this is the market review, so this is the other presentation. So this is the one opportunity during the year where we get to use pictures and cartoons and keep it a little bit lighter for everybody.
On behalf of Commissioner Biggs, thank you for the pictures.
So this is a recap of 2017 and a little bit of an outlook for this coming year. During 2017, we continued to see a resilience of investors' risk-on sentiment, which drove markets higher. That was it was done in an uncharacteristically volatility-free market, despite the many potentials for geopolitical uncertainties to derail the markets. Investors continued to pour money into risk assets, which really drove prices for those assets higher. Towards the end of the year, we did see tax reform come in, which added a bit more fuel to the fire as that increased the amount of savings and investable income for individuals to pump back into the markets, and also lowered the tax rate effectively for a lot of companies in the U.S., which read through to the underlying analysis in Wall Street. Just on face value, it allows more money to drop to the bottom line for the companies, which is at the end of the day what they're valued on. So the impacts of tax reform have not yet been seen, but the effects have been priced into the market. So that is one of the things that drove markets towards the end of the year. We'll kind of wait to see how that really plays out from an earnings standpoint. The jury's still out there yet. The last two major points that we wanted to point out in 2017 were that we did start to see some inflation come into the market, which is what we've really been waiting to see for the Fed to continue on its path. So it's coming in at a relatively subdued rate, but nonetheless, I'll show you later in the presentation, it is ticking up incrementally. And lastly, the thing that's been making a lot of news of late, Janet Yellen did not have her term renewed as Fed chair. We have Jerome Powell coming in as the new Fed chair, and that's potentially changing how the Federal Reserve could be acting towards markets and changing rates. We've obviously seen that take place, especially today with his testimony. The market's really now pricing in that there could be a regime change in the Federal Reserve. We're watching it very closely. We think that you're very well positioned with your portfolio, and I'll get into that here in a little bit. But those are the major changes for 2018 that could be impacting the markets kind of on a going forward basis. On page 3, we have a distribution of S&P 500 returns over the last couple of years. We think this is really interesting. You can see all the way on the left-hand side there, 2008 returns at negative 37%. Since that point, we haven't had a single year where the S&P 500 has been negative. And we're using this as a great illustration to temper expectations. We've had a great run over the last couple of years, but we want to be mindful that having a diversified, balanced portfolio is prudent, because this distribution is semi-normal, and there is a left-hand side to the distribution. We tend to forget after a long period without any negative markets that they can happen. So just reaffirming that, the way that the portfolio is positioned is definitely taking this into account. On page 3, we take a look at the yield curve. This is changed quite dramatically over the last couple of years. You see 2010, which is that dark line, very steep yield curve, indicative of where we were in the cycle. And on that orange line, 2017, we saw the Fed tightening from the short end of the curve, as well as the long end of the curve, coming down slightly as multiple things happened, but notably inflation didn't take off. It was prevalent, but it didn't take off, causing the long end to expand. But also, there's what we call kind of in our world, it's called a carry trade, where basically, the U.S. on a relative basis has got really higher yields than the rest of Europe and some of the more developed Asian countries, leading it to be a very attractive place for other foreign investors to invest. So we think that could also be holding the long end of the curve down. Now, since publishing this chart, the long end of the yield curve has popped up to about 2.9%, and that has a lot to do with inflation expectations and what that means for the dollar and whether or not it could be weakening and changing some of the relative pricing there. On page 5, we really try to encapsulate what this meant for investors. In 2017, U.S. equities had a very strong return, but for the first time in a couple of years, they were eclipsed by their international counterparts, and that had a lot to do with economic improvement in Europe picking up, as well as the weakening dollar. So relative for a domestic U.S. investor investing overseas, as the dollar weakened, those assets performed well. Additionally, large cap stocks outperformed their small cap peers, and equities in general continue to outperform on a longer term horizon. What we will point to here also on this chart from a 10-year standpoint is after this year, 2008, we'll be dropping off that 10-year number. So the 10-year, depending on what the markets do this year, could look a little bit more representative of what everybody's been hearing in the news. In the fixed income world, there were 3 rate hikes from the Fed in 2017. Currently, it's forecast that there's going to be three more in 2018. I think that's changed quite a bit in the last week or two. I think that the market's now pricing in a higher likelihood of there being 4 rate hikes. But again, there's no certainty there. That's just what the market is projecting or is implying right now. From a fixed income standpoint, if you look all the way, the third from the bottom on the 2017 column, you can see that international fixed income had a really strong year, and again, that had to do with the weakening dollar really helping to drive those returns. And lastly, on this page, I'll point your attention to the bottom line, and you can see how inflation has incrementally been increasing. And this is CPI, this is not PCE, so it's not the gauge that the Fed uses, but it's generally the broad proxy for inflation. And you can see that it has incrementally been ticking up, not yet to a point where we think that the Fed would take drastic action yet. On page 6, we want to really draw your attention to 2 asset classes in particular. This is a review of individual asset classes, how they performed, and then how we think that they or what the environment could imply for 2018. Your active equity managers, those are your managers that have the discretion to look different from a benchmark and position maybe for being growth oriented or value oriented or higher quality and defensive. And we think that it's been a really difficult market for them for the last 9 years. We think we're entering into a market that's going to be a little bit less macro-driven, so individual security selection and the ability to look different, be a little bit more defensive. We think that 2018 will be a better environment for them. That's not guaranteed by any means, but, we think just the way that the economy is shaping up where we are in the cycle, this is an environment where we would look to your active managers to be a bit more of a driver of returns relative to passive markets. Additionally, your unconstrained fixed income, this is something we talked about the last meeting, but these are your managers that have the flexibility to be either longer or shorter duration, so having more or less interest rate sensitivity. We think that you're very well positioned there. It's benefited you the last couple of years as we started to see rates rise a little bit. We think you continue to be well positioned there as the Fed could be moving rates, at a more sustained rate than they have in the last couple of years. Stop there if there's any questions on the markets or anything that we presented. Otherwise, I can go into kind of our timeline for projects for this year. Okay. On page 7, this is just briefly a timeline of the projects that we will be providing for you. This is part of our co-fiduciary duty. These 4 projects that you see for the quarterly projects are the big projects that we deliver to you every quarter. All on the right side here, these are all the things that we're doing in the background for you that you don't necessarily see that we try to do as an advocate for you with fund managers, with your custodian. And one example of this would be that Strategic Alpha share class exchange, where we found that a new share class came to the market that could save you on fees. We went out and worked with Schwab, your custodian, to get that share class on the platform so that you could realize those fee savings. In May, we will be presenting your first quarter performance and evaluation report, as well as a comprehensive fee analysis to benchmark your fund management fees, your custodian fees, as well as the investment consulting fees. In August, we will be presenting the second quarter performance and evaluation, as well as doing a portfolio construction to reaffirm that the portfolio is adequately or is allocated in accordance with your expectations, and that you're still comfortable with that composition. In November, we will be doing an IPS review to restate the appendix of the IPS, just to update it to make sure that we've captured all of the changes in the fund, and then in February of I guess this will be this meeting right now for 2018, but we'll be doing probably a very similar presentation in 2019 in February to go over what happened in the markets and provide you with that update as well as the performance and valuation. So with that, I'll hand it off to Joe Bill, unless there's any other questions.
So I know we're only 2 months into this quarter. I mean, is there anything that you want to tell us about this quarter and how we're doing thus far?
Yeah, absolutely. I can tell you, as of yesterday, the portfolio was $156,843,471. That obviously there was the cash flows, which is why it has incrementally ticked down from the last presentation. But that resulted in a 1.17% return for your investment. So we are positive during the quarter, despite the volatility.
Yeah, that was my thought. So,
yep.
Okay, great.
Any other questions? Joe Bill.
Okay, if you'll flip then back past tab 1, and I'll real quickly tell a story on myself, Dan, based on your comments about the cartoons. I used to work for Senator Lugar 30 years ago, and I had to, as part of my travel with him, get whatever amount of papers were in the hotel lobby shop. So normally there were 6 or 7, and I would take them up to his room. And USA Today was new at that point in time, and he would always give me the USA Today and say, Joe Bill, you can start with the one with pictures. So if you'll go to page 1, I'll just give you a quick market overview. So, it's kind of deja vu of what Peter said happened in 2018 as a whole. We had a strong performance in the equity marketplace in the fourth quarter of 2017. You can see with the blue bars that represent the quarterly returns, we had positive returns across all styles of equity investing. Growth did better than value. The growth as we've talked about in previous meetings, was led by the 5 tech stocks, basically, that we've talked about, Facebook, Apple, Amazon, Netflix, and Google, drove the market. But also, consumer discretionaries did very well, and financials did very well during the quarter. Healthcare and utilities kind of lagged, but we still had positive returns, which benefited the portfolio. The Fed raised rates in the fourth quarter by 25 basis points. It hurt on the short end of the curve, so you can see to the far left, down at the bottom, we saw negative returns in defensive and intermediate fixed income, modest returns across other fixed income investments. The dollar dropping, against other currencies helped not only in the equity space, but in the fixed income space with regard to returns with foreign, both equities and fixed income. So what did that mean for your portfolio? You earned a return of 2.5% in the fourth quarter. Over the last 12 months, you had an 11% return. We really have no concerns down at the bottom with our stoplights with regard to managers. At the end of December 2017, you ended up with $161 million, just under $161,800,000, but we've talked about the distributions that were taken out, and so your balance is obviously what Peter indicated a few minutes earlier, but everything is going well with the portfolio. We're pleased with how it performed. You're at 45% equity, 55% fixed income, so you didn't benefit on the total upside with the equity markets, but you're not trying to do that because of the way the portfolio is structured for the purposes you have determined appropriate. So we're very pleased, and I'll cease fire, and if anybody has any questions, we'll be happy to answer.
So we stay within our margin of error, not margin, our breathing room on our equities allocation throughout the year. We didn't have to do any
Rebalancing?
No.
That's good.
Additional questions? Mr. Ritzy, Mr. Vesley?
Not yet.
Okay, great. Thank you guys.
Thanks.
Thank you.
Thank you.
Safe trip home. Thank you.
That's good news, huh?
It's always good news. Look at favorably.
Okay, so obviously a very, very good report through the end of last year, and actually with the volatility that we're seeing in the market so far this year, we're still ahead, which is a good thing. One thing that I would like to present to the board is a resolution, which I'll distribute now. One thing that we do know, with as good as the report was that we just heard and that we've witnessed since the inception of the foundation, we know that we can't always count on those types of returns. It's the market, and there's risk involved, and so as a board, I think we have a responsibility to make sure that we appreciate and enjoy the successes that we have with the return, but also be well prepared in the event that things don't go quite so well. I think everyone remembers not too long ago, just a couple of weeks ago, in fact, the market went crazy, and we had a significant loss in the market, where the Dow at one point during the day was down 1,595 points, ended up the day down 1,175, down 4.6% in one day. So that was the worst point decline that we saw on the Dow in history, as I understand it.
Just like that, it was gone.
It was gone. So it settled in so that at the end of the day, on that day, February 5th, we were down 4.6% for the Dow, and we were down 4% for the NASDAQ. So there's obviously, if that's not an indication that there's risk involved with what we're doing, I don't know what would be. And I'd say that as a foundation, we're secure in the sense that we are limited in terms of how much of funding we can have in equities versus fixed incomes. However, there's still risk, and knowing that the market is volatile, and we need to be, I think, have a conservative approach to managing those funds, the idea of a resolution to basically establish what, for lack of a better term, would establish a rainy day fund within the foundation holding account was presented and discussed. So what everyone should have in front of them is what that resolution states, and what I'd like to do at this point is read the resolution and then open up the floor for discussion. So it comes now, the Board of Directors of the Porter County Government Charitable Nonprofit Foundation, Incorporated, hereafter known as the Board, whereas the Board has previously established the Foundation Holding Fund and the Foundation Budget Fund, and whereas the Board recognizes the need to establish a rainy day fund to be held within the Foundation Holding Fund to facilitate the continued funding of the Foundation Budget Fund. So there's a lot of funding discussion in terms there that I'm also going to have the board attorney kind of further clarify and or simplify for the group. If the foundation does not produce sufficient earnings in a given year or years, and whereas the board believes the rainy day fund to be held in the foundation holding fund should be at least 3 times the previous year's approved foundation budget, therefore be it resolved by the board as follows, that the Board of Directors of the Porter County Charitable Nonprofit Foundation, Incorporated, resolved to save at least 3 times the previous year's approved foundation budget in the foundation holding account. And so that's the resolution that you have a copy of in front of you, and what I'd like to do at this point is have...
Well, if I could chime in just real quick before we throw it to Harold, Mr. Chairman. So, because I know Harold and I have talked about this a little bit, this is kind of the conceptualization of, or the memorialization of our conceptualization of the money. And we've all sort of had and bantered around what we think we can do to ensure that in a negative cash flow year, we don't have to go back and tap into principal because of this notion of a negative flow, and we have to get a 10 out of 10 vote to go back to principal to fund the foundation budget. So I'm going to help Harold out here a little bit. So as you know, for the benefit of the people in the audience, we get 5% of up to 5% of the earnings coming into the county. So what we've done previously is we've designated a place for that money to go, and that's our foundation holding fund. And then out of that, we have our foundation budget that we draw money from every year to pay for the things that we pay for in our foundation budget. That's not the whole 5%. If we do earn 5%, so the question is what happens to the remaining money that we don't use for the foundation budget? Well, that sits in the foundation holding fund. We as a group have decided over the past year that we want to have a buildup like any corporation or any entity that has an ongoing concern that they have to pay, particularly with taxpayers, that we have a buildup inside that holding fund that we can use for our foundation budget in those years that we don't bring in enough money to pay for our foundation expenditures. So this rainy day fund is exactly what we've been talking about. We're going to build up 3 years of our foundation budget as a rainy day fund to use if we have bad investment return years. It is a very conservative approach. We're going 3 years, but we are a very conservative board, and we are a very conservative board because we are talking about public money, and in that foundation budget, there are things being paid out of that that are very important to the safety and the well-being of our constituency. So it is a hyper-important and sensitive budget that we always have to maintain the integrity of funds to make sure that we pay those things that we budget for. So with that, I would just like to encourage the board to follow through with this, but I hope I simplified that a little bit.
I don't know if Harold, do you have anything to add, or Scott, if you have anything you'd like to add?
I don't. I would
to Dan's comments?
everything that Dan said.
The only thing I would say is that, for the auditor's benefit, the term rainy day fund within the holding fund is not meant to be a State Board of Accounts term of art. It's just conveying the concept of having 3 times set aside within the holding account to weather those bad days.
We labored over what to call it, but it seemed like for simplicity's sake and for transparency, it just seemed like a very good name to call, a build-up. Let's hope it doesn't rain, guys. Let's hope that we never have to go to that, and we get our 3 years built up, and, you know, we're living in Fat City.
It will rain.
But it will rain. It always does.
It will rain. Okay, would someone like to make a motion?
I'll make that motion.
Second.
There's a motion on the floor that has a second to approve the resolution as read and discussed. Any additional discussion? Okay, roll call, please.
Councilmember Graham,
Yes.
Councilmember Jessen,
Yes.
Councilmember Wexler.
Yes.
Councilmember Witten,
Yes.
Councilmember Bozick. Yes. Councilmember Reaver,
Yes.
Commissioner Good,
Yes.
Commissioner Blaney.
Yes.
And Commissioner Ritchie.
Yes. Thank you very much. Attorney's report. Harold, anything else to report this evening?
All I could or can report is that I was in contact with Kat Sapper in February, and the plan is to do the audits in May or June of both foundation years, and they're on track. They've been in contact with Vicki, I know, and the State Board of Accounts, and so everything's on schedule.
All right, thank you very much. Attorney McClure, anything to add?
Nope.
Motion to adjourn. We need to set a date, or, no?
Has there been a date for the next meeting? We will forward that date as soon as available. All those in favor of adjournment?
Aye.
Say aye. All those opposed?
Aye.
Meeting is adjourned. 5 minutes recess before we begin.